This is Tom Homes for Sale, bringing you our 2025 Market Outlook, sponsored by Vidona Residential. Real people, real relationships, real estate. Coming up, we have our in-depth analysis from our residential real estate expert. In the meantime, let's throw it to Brock Statman at the big board for his market forecast.
Thanks, Tom. Starting off, let's talk about the number of new listings for the Baltimore and DC Metro areas. Overall, there hasn't been any meaningful change in the inventory levels for those areas, only a 3 to 4% reduction in the number of new listings this year as compared to last year. The same thing goes for new pendings. It's about the same as last year. This means inventory levels will likely be similar to 2024. Remember, to calculate the months of inventory, you divide the number of active listings by the number of new pendings for the month. Less than 4 months is a seller's market, more than 6 months is a buyer's market, and 4 to 6 months is a balanced market. What we're seeing is the inventory levels are pretty steady compared to last year, albeit slightly higher. We are firmly in seller's market territory with less than 2 months of inventory for both metros. From what we can see, no trends are changing, which means to expect continued price appreciation at this time. In terms of the median sales price, we can see for the past 3 years prices have been going up, but the rate of appreciation is not as high as it was during the pandemic. Even though rates are now higher than the past 30-year average of 5.56%, homes are continuing to appreciate. It only makes sense that demand would go up if rates came down, except someone that buys at today's interest rates only has to refinance to take advantage of future lower rates while paying today's lower prices. Let's talk about new homes. New construction housing has been steadily increasing, and we are finally hitting the long-term average of 1 million units per year. But we are still short 4 million units that weren't built during the recovery from the Great Recession. This isn't something that can be solved quickly, as it's constrained by materials, labor, regulations, and time. We really need to be building more than 1 million units per year to make up this lost supply of homes. In terms of total home sales, we are seeing the least number of homes sold in recent years. This is due to a decades-long lack of inventory of homes for would-be buyers and lower affordability due to higher prices and interest rates. Even though we saw about the same number of sales in 2008 during the Great Recession, we haven't seen less sales than 30 years ago in 1995. Since 1995, the population has grown by 28%. This low level of home sales is unsustainable and is really constrained by a lack of supply and lower affordability. Back to you, Tom.
Thanks, Brock. For in-depth analysis of the real estate market, let's go to Vishal of Vidona Residential. Vishal, what do you see happening in the future of the real estate market?
Thanks, Tom. While we haven't seen much change in the past year, let's talk about what may impact the future of supply and demand. Right now, there are policies underway that will likely cause prices to go up. If you look at the percentage of immigrants that are in the construction labor force, it's pretty substantial. Negative immigration policies will reduce that labor force, resulting in higher costs and home prices due to builders having to pay higher wages to attract workers. Those higher costs and home prices will result in higher inflation, which ultimately causes the feds to not lower rates and affordability to go down. If we look at construction materials, a large portion of those materials are imported, with 80% of all lumber imports coming from Canada alone. Tariffs are a tax, which means they will raise costs. Higher costs leads to higher prices, which leads to higher inflation, which, as we just discussed, means less likelihood of reduced rates. Property owners will benefit from these increased costs, since demand will need to be fulfilled either by for sale or for rent housing. If it costs more to build, it will cost more to buy, meaning rising values for property owners. All that being said, there are some forces at play that could cause lower prices and increased supply. That is the ongoing restructuring of the federal workforce. This is something that will have a ripple effect throughout the economy, even to non-governmental related jobs. This could result in lower demand and possibly higher supply if people need to sell their homes. This higher unemployment could cause a recessionary effect in the economy, incentivizing the lowering of interest rates. This will help increase affordability, as it could push the market closer to a balance point while lowering monthly payments. These are the factors that we can reasonably predict will impact the real estate market, but there are other factors at play that are complete wildcards. We call them Black Swan events because they're typically very rare, like a Black Swan. They could be things like unpredictable policies, natural disasters, civil unrest, war, and even pandemics. For the sake of this update though, let's stay focused on what's probable instead of what's possible. Simply put, in a market where you have low supply and high demand, you will see increasing prices as we are right now. Until we reach a balanced market between 4 to 6 months of inventory, you won't see any downward trends of prices. But if we reach a market where there is high supply and low demand, then you will see lowering of prices. Let's talk about what is keeping supply down and demand up. Right now, homeowners are equity rich. 69% of homeowners have at least 50% equity in their homes. This means even if they're forced to sell, they can do so and avoid a short sale or foreclosure because they have enough equity to cash out, which will help insulate prices. And of the homeowners with mortgages, over 74% have an interest rate below 5%, with over half of them having a rate at 4% or lower. At the end of the day, they're going to need somewhere to live, so it's likely cheaper for them to stay put than to sell and buy or rent elsewhere. This combination of low interest rate and high equity is just part of the reason why you won't see a wave of foreclosures or short sales. The domino effect of falling prices during the Great Recession was caused by sellers having very little equity and higher variable interest rates. So that's what's happening from a supply perspective. Let's talk about demand. What has been supporting the natural demand for homes is the millennial generation. They are larger than the baby boomer generation, and they're nearing major life milestones like marriage and first homes, as well as their peak consumption years. Keep in mind that many of this generation have been held back from purchasing a home due to the lingering effects of the Great Recession. This is why the median age for a first-time home purchase has been increasing. The largest wave of those first-time millennial homebuyers hasn't even entered the market yet.
Wow, this is a lot of great information. What would be your best advice to somebody who might be buying, selling, or investing?
To them, Tom, I would say think of this as trying to catch up to a train that is leaving the station. You have to do everything necessary to catch up to the train and hop on. But once you're on the train, its momentum will continue to carry you forward. This next real estate market is going to be much better for those that own real estate than those that don't. Think of us as a conductor to get where you want to go in the Baltimore to DC Metros and beyond.
This has been our 2025 Market Outlook sponsored by Vidona Residential. We now return you to your regularly scheduled programming.